Most investors think the reason they are stuck is because of money. If I had more capital, I could do more deals. No, that's not true. Money is fuel, not the engine. If your opportunity is good enough, money will always find you. But the real question is this: do you know which type of money fits which type of deal? And that's the reason why I'm here today. You might be wondering, why listen to that guy, and who are you in the first place? Well, my name is EJ. I started here on YouTube a year and a half ago talking about business and mindset stuff. Roughly 4 to 5 weeks ago, I separated my content into 2 different buckets, and this channel here that you are watching is about my real estate learnings. I've been doing real estate for 20 plus years. In the US, here in Europe, rentals, flips, major renovation projects, new construction, everything, I've done it. And the reason why I'm here today is to pass those learnings to you and maybe help somebody else during their journey as well. So that's why I'm here, and today's video is all about funding, like I mentioned. So don't worry about the money. It will be there if your opportunity is good enough. But there will be 4 ways to fund your deals, and that's why I'm here. So I want to talk to you about those, explain the details, when to use them, when not to use them, what are the pros and cons, and so forth. And also use my own examples with real numbers here so that you can see what I have done in the past so that you can learn from these. Let's look at the first page here. So the number one myth, like I mentioned in my intro in real estate, is that people think that money is a big bottleneck. When I started, I had the same thinking. I was like, I can't make money because all the upfront investments in real estate are so big. It's not possible because my pockets are not very deep. But the real thing is that people with money, they always look for opportunities. If you look at money as this big thing up front, so people in the top of the pyramid, so the top 1%, top 5% in the world, they find opportunities all the time. Money is like this liquid or like this water that when you pour it down, it's like a waterfall. It trickles down, it finds all the cracks and it fills them. So it desperately wants to find these opportunities that makes more money, right? So that's why funding is not going to be a problem. So your job is to focus on finding the right opportunity, and then the money will follow, because money always chases good deals, like we mentioned. And like I said, there will be 4 ways how to fund deals, how to find money. I'll cover those today. But before going there, let's look at the next page where you have this very simple diagram. And this is what you need to understand when you get started. So you have these 2 top buckets here. You have engine and fuel. Like I said, engine is the real deal. So that's like your V8 engine that needs fuel to operate. Money is the fuel that goes into the engine so that it can keep cranking, so to say. And the output is your profit or your return on investment, your rental income, or whatever your goal is in your given project. But the engine, the deal flow, being able to execute, find the opportunities and turn those into money-making machines is the real deal. And then, like I said, this fuel thing today that we're going to cover, and there are 4 of those, is the focus of today's video. If you are more interested in the engine stuff, meaning how to make this machine work, my first video is about finding opportunities and how to turn them into real money-making machines. So make sure you take a look at those as well. But let's move on. So capital sources, 4 different versions. So number 1, you have bank loans. That's the so-called traditional financing. Everybody knows that. That's the Citibank, that's the Bank of America, that's the Deutsche Bank, and these types of traditional institutions. Then you have the hard money and private lenders, and your own money, of course, what you have in your own pocket, your savings, so to say. And then last but not least, partnerships and joint ventures. Today, pros and cons about all 4. What I have done, I have actually used every single one of these 4 in my deals. I have done roughly 300 transactions during my 20 plus years. And I have used every one of them, like I said. So there will be some stories that I'm going to share with you and when to use each and every one of these. So let's get started. Number 1, bank loan. Look at it this way. So this picture here illustrates a traditional institution. Something has been there for hundreds of years. And the thing with the bank is that look at banks as a generalist. So they are a source of money for all kinds of businesses and private individuals. So they are not really specialists in any one domain. Real estate is a good example. When you go and negotiate a loan with the bank, they will be looking at you as an individual more than the opportunity itself. So the bank is always looking back. So what have you done in the past? Show me your W-2 or your employment records. What is your annual salary? And let's look at your history. Or if you already have a corporation under your name, they want to see your P&L, profit and loss statements, and your balance sheets and all of that from the past. So bank is the one that looks into your past. They don't look at the future at all. And this is a very key thing to understand when you look at financing. One of the benefits of using a traditional institution like a bank is the fact that they are the cheapest out there. If we don't look at our own money, of course, because there's no interest to that. There's only the opportunity cost. But they are also the least flexible. So if I can get a favorable 30-year fixed mortgage or an investment loan from a bank, it's hard to qualify, like I mentioned. So they are very rigid. There's lots of bureaucracy. There's lots of paperwork involved in that, but also the interest is the lowest possible out of all the financing options. And I would say that banks are best for long-term buy and holds and larger commercial and residential projects. These are the types of deals that I have used traditional financing for. The key thing to understand is that these people, they underwrite you first and the deal second. And every time I've gone to see a bank to negotiate a loan for my future deals, it's always about the past. And that's really what frustrates me. And it seems that there's always new kinds of regulations and rules in place. After the financial crisis in 2008, there were new rules being implemented, introduced, and it seems to be happening annually. And that's something that I don't personally like, but it is what it is. So bank financing, like I said, it's been good for me for rentals, and it's been good for me for residential and commercial projects, but that's about it. I try to actually stay away from it. And now I'm in the process, in the phase of my life where I'm trying to pay off my traditional bank loans. I try to be more free and clear with my properties, improve my cash flow, because like I said, I'm not the biggest fan of banks, but there's a place and time for these. So do not discredit them, so to say, but use them wisely. That would be my recommendation there. On the next page, there is going to be just a simple rental house with bank loan type of a calculation. So this is actually from one of my deals. So if you look at the purchase price, 300,000 here, 75% LTV stands for loan to value. It means that you get 225,000, and then interest rate, as an example, 7.5%. It gets amortized over 30 years, and you look at the payment here. There's some closing cost, additional cost, and in this particular case, your net cash flow per month is 430. Nothing really complicated here, but the whole idea is that banks, they give you, if you look at the LTV, the loan to value number, that's actually very high. I would argue that it's probably a lot lower nowadays because banks are even more conservative. Plus the fact that if you are a first-time buyer, they want to see other collateral, other assets being used as collateral, or maybe more money out of your pocket so that they finance your deal. But the whole idea here is that they look at the purchase price as the basis for the LTV. On the next page, when we talk about private lenders and hard money lenders, they can use the ARV after repair value as the baseline. And there's a huge difference. I have calculations regarding that. On the following pages, we'll be looking at the difference there when you see the true difference between a purchase price and the future value of the property as the baseline. So this is a key thing to keep in mind. And if you can put less money in, you can actually grow faster. So that's really the key thing to understand. But this is obviously more favorable when it comes to rent, when it comes to rates. So that improves your cash flow. But simple calculation here. So then moving on to capital source number 2, which is hard money lenders and private lenders. And if the traditional bank looks at you first, is going to qualify you, look at your credit score, your W-2, your employment records, and all of that, your bank statements. Hard money lenders, private lenders typically look at the opportunity first. So they look into the future versus into the past. And there's a huge, huge difference there. And you being a first-time flipper, first-time real estate investor is not a bottleneck. It's not a showstopper, so to say. It might slow you down. You will pay more points up front, and your interest rate is probably going to be higher, but you still get the financing. And the good thing also is that these people are specialists. If you think about a traditional bank, they are generalists. But a hard money lender or private lender knows what they are doing. They are in this domain. They operate. They have done probably tens or hundreds of deals in the past, maybe thousands. So they know exactly what's going on. And they might have very good references for you. They might have contacts for you when it comes to rehab and listing agents and all of that, all the stakeholders in the value chain. So this is really important to keep in mind. And the other huge thing is the fact that the loan to value percentage, whether it's 50, 60, or 70%, doesn't really matter. It's typically, with the known players, it's off of the ARV, so after repair value, not the purchase price. Simple example. So if I buy something for 200,000, the bank would give me, let's say, 70% off of that, right? So they would give you, using simple math, 140K. So 60K is down payment, 140K is the loan. But if I use a hard money lender and the 200K purchase using 30K as my rehab budget would be all of a sudden 300,000. They finance the deal based off of that 300,000 after repair value. And that's a huge thing when it comes to how much money you have to put out of your own pocket. Short-term financing secured by hard asset collateral, which is the real estate, and it's opportunity-based, not so much based on the individual and their past track record. And underwriting focus on the property, exit strategy less on the borrower. Speed and flexibility is a huge pro here, a plus. Obviously, it comes at a cost. So usually you would pay 1 to 2 points, so percentage points upfront as an upfront fee. And then your annualized rate would be somewhere in the 7 to 15% range. There's a huge variation. 7% right now in the current environment is probably too low, but typically it's been somewhere there. When I used hard money lenders in the past, it was typically 8 to 9%. This is when interest rates were lower. But my strategy with hard money lenders has always been this. So if I go back to the start of my entrepreneurial career in real estate in the US 15, 16 years ago, I set up 2 companies. And I had one which was 100% owned by me, and the other one was 50-50 by me and a joint venture partner. But if I look at the company that I owned 100%, I had enough money, my own money, that I was able to buy my first deal out of pocket, use my own money. And then after that, I used the hard money lenders to pull equity out of that property that I own free and clear. And that's how I was able to scale my operation a lot faster versus just nurturing that one deal that was free and clear and then selling it using the proceeds plus the profit to buy something else. When you are able to leverage the existing asset that you own free and clear using hard money lenders, so you get money quickly and they look at the opportunity again when it comes to what you're buying next versus you as an individual, because I had just quit corporate and my company didn't have any fully annualized results available. So it was hard for me, almost I would say impossible for me to get any traditional bank loans. So I didn't even go down that route. So I wanted to just use the most flexible type of financing for my deals. So that's really important to understand. So summarize hard money lenders, so they look into the future, not on the past. They are specialists in that domain, plus the LTV is based on the ARV typically. Not everyone, but typically the best ones can do that. On the following page, there's a calculation. So we're comparing hard money to a bank loan. And here I have highlighted in red the rows that we're going to be looking at in more detail. So loan basis, like I mentioned. So let's look at one transaction, similar purchase price, same rehab budget and total project cost. Let's see what the end result is in terms of flexibility and difference. So if your bank is giving you 70% of the purchase price, and here purchase price is 150, so your loan amount is 105. So that means that cash you bring, so cash out of your pocket is 95,000. So it's the 41K down plus the 50K rehab budget. That's the line number 2. But versus hard money lender, so they would give you, and I'm using a conservative approach, so they would give you 60% based on ARV, and here it would be 70. They could be 60 and 60, so then it would be even more favoring hard money loan over a traditional bank loan. But let's use this example just to keep it simple. So then your loan amount would be 168,000, but the money out of pocket is 32,000 versus 95K. So imagine how much faster you can scale your operation. Let's say if you had 100,000 of your own money, for instance, you could do 3 deals versus just 1. That's the whole idea. Of course, what I didn't show here is the impact on points, of points on your profitability and the interest rate. Of course, that plays a huge role. But then we come back to the engine, which I introduced on slide number 3, if I remember correctly, where you really need to understand that you focus on bringing in the right opportunities. So of course, when you know that you are using a hard money lender, you so factor in the points and the percentage into your holding costs so that you actually still make money. So that's the whole idea. So you only acquire those opportunities that make money for you down the road. And then coming to topic or capital source number 3, which is your own money. Like I said a couple of minutes ago, the way I started in the US, when I started my real estate development company, I started doing flips and larger renovation projects. I had 2 companies set up. The other one was 100% mine. The other one was a 50-50 joint venture. More about that in a few minutes. But the company that I owned myself, I had enough money to purchase 1 property free and clear, and then I used hard money lenders to scale. So then if we summarize my own money or whatever your savings you have, it's obviously the simplest and safest way to do. So there's no outside party qualifying you or the opportunity. You don't have to explain anything to anybody. You don't have to show your W-2s or your employment records or your bank statements or anything. There is no bureaucracy, so to say. So you just, obviously you're free to do whatever you want with your own money. But I wouldn't actually shy away from that, especially hard money lenders and appraisers doing work for you, because they actually can bring a lot of value. So there could be things that you miss if you haven't done too many deals yet. And therefore, having somebody else look at the numbers, make sure that you understand the purchase price, the rehab, and especially the ARV, and the market in particular, what's the demand and what's the supply like. So therefore, it's actually a good thing that an outsider come in and help you with your due diligence, so to say. And money is always one form of leverage. So there's 4 of them: people, capital, code, and content. So the whole idea is that you make sure that money works for you. So as long as you can take somebody else's money and the interest you pay is significantly lower than the return you get on that capital, so you're safe, you're good. And then you can basically endlessly scale your operations that way. Negotiation power: when you have money, you have the bank statement, you can just basically close in a couple of days. That's a huge benefit, obviously, and speed and control. But there's always the opportunity cost. So it's not free money, because opportunity cost is a real thing. If I have 200,000 in my bank account, I could do several other things with that. I can ask myself, okay, what's the risk-free return on my investment if I put all of that money in government bonds? Maybe I would get 4 or 5%. So use that as an example. If I put that in a low-cost NASDAQ index fund, okay, so maybe that would be 10%. Okay, there's a little more risk involved in that. But there's always an opportunity cost, so that's good to keep in mind. But your own money, I've used it. I actually favor it because that gives me a lot of flexibility. When I own something free and clear, then I can always use leverage after the fact. Numbers tell more than 1,000 letters or text pages, so to say. So let's look at a real life example. So hopefully we can open this up for you a little bit. So deal own money versus leveraged bank loan. So that's the whole idea here is to compare these 2 deals. So the purchase price here is 200,000. So if obviously you use your own money, there is no loan from the bank. So your cash out of pocket is the 200K, obvious. And leverage, if you have a bank loan, so obviously 75% LTV is too high, but it doesn't really matter in this calculation right now. There would be then a 50K down payment. Annual net operating income before debt would be 16K. But here the big difference then is the cash flow. In your own money example, it's 16,000 versus 5,200. But look at the next line. So cash on cash return on investment. So the whole idea is that you compare the number that you bring in versus how much money you have invested in that. So here's the thing. So scalability. So if you only use your own money and there's no leverage involved, so you're basically stuck in one deal. But real estate is about growth. All businesses are about growth. So if you were able to use the 50K down payment and you were able to, let's say you have 200,000 of your own savings, if you used leverage, any form of leverage, in this case, yes, 75% is a little too aggressive. So maybe your own money requirement would be more than that. Let's say it's 60K, but still with 200,000, you would be able to do 3 to 4 deals simultaneously. So you control more assets. And then here's the thing. Remember, real estate is all about building equity. You can do it in 3 ways. You can build equity by buying below market value, by rehabbing smartly, and by riding the market. So if you know what you're doing, so again, the engine that we introduced in the beginning, so you understand how to find opportunities, how to execute those opportunities. So when you buy something at a wholesale price, you already built equity. Then you rehab it smartly. So there's another way to build equity. So there are 2 ways already. And then when the property is in a Class A location, in an area where you have employment growth and population growth, right? So then you can assume that the market goes higher. So then the whole idea is that if you control 4 assets, for instance, and then they are in Class A locations, you get Class A tenants, and the value goes higher. So then all of a sudden, leverage makes a lot of sense, right? That's the whole idea here. Number 4, partnership and joint ventures. I'm a big fan of this, and I have used partnerships in the past, and I've referred to this a couple of times already. When I started my 2 companies in the US, the other one was mine, the other one was a 50-50 partnership with actually my former boss from my corporate days, a wealthy individual, and we partner up. So the whole idea is that because of my background, I had done real estate as a side hustle, remember? Here in Europe, mostly rentals, some flips and whatnot. So I had some exposure to the market, but I was super honest about my background, saying that, okay, this is a new market. This is a city I have, yes, lived in, but I haven't done a single transaction. I don't know anybody here. I don't know any agents. I don't know any buyers or sellers. I don't know anything about this thing here. So I need to learn for sure. So if you're willing to partner with me, I'm gonna do a 50-50 split with you. And that's the thing on the next page. So typical structures, so 50-50 sweat versus capital. So the whole idea is that I would be the person doing all the work and he would just basically give me the money. And then at the end of the day, we split whatever we do 50-50. So when people tell you that you can't start in real estate without any money, that's complete bullshit. No, this is the way for you to make money in real estate without any money in your pocket. You obviously need to understand how to find opportunities. Again, coming back to the engine part, money is, remember, the fuel that cranks up that V8 engine. So I was the one putting together the value chain, the people in that network, the people rehabbing the property. I created the network, the relationships with the agents, and I was marketing to homeowners directly as well. So I was the machine creating opportunities, and then I was putting the whole thing together, and he gave me the money. He was the fuel that filled the cracks. And then we were able to make money and then split it, and everybody was happy in the end. But this is the way for you to get started. So you just need to obviously know what you're doing. So basically the bridge between no money and building serious wealth. Turn your skills into equity, like it says here on the slide. But this is a really, really viable way to get started. And I think in an ideal world, what you do is that you use a hybrid model where you just basically do partnerships depending on the deal. And that's what I've been doing here in Europe too. I'm actually, most of my major historic renovations here in Europe, projects where we have taken a very old building that was maybe in office use or something else, and we maybe did some re-permitting, rezoning, and then some tricks with the city and being able to force the value to go higher by first rezoning it, applying for a specific permit, and then actually turning those old, let's say, offices or maybe even older apartments into brand new versions, so to say. So we were able to kind of build equity and do that. But all of those deals were 50-50 partnerships on my part. The new construction stuff was only mine, and the flips were mine, and the rentals were mine. But the historic renovations, the larger renovations, were actually always 50-50. And it just worked out really well. I'm a big fan of this. For you to get started, even do more advanced deals, whether it's commercial, residential and whatnot. But this is a really, really good way. The key thing I would highlight here is to make sure that you have absolute clarity. The roles and responsibilities need to be super clear. And it's the chemistry, how well people work together. It has to be complementary, because many joint ventures, they turn ugly at some point. So this is really something that needs to be highlighted, and written agreements, obviously. Typical structures, like I mentioned already, so we looked at 50-50 sweat versus capital. I've done number one and number 3. I haven't done preferred return plus equity split, but I won't be going through every single bullet here. You can read them. The whole idea is that in number 1, it's the 50-50. One party basically does all the work, the other one brings the money, and then they split everything 50-50. And the silent equity partner, a fan of that too. Investor provides equity, and then the operator runs deal and basically makes all the management decisions, and then equity split is depending on what the agreement looks like. Moving on, just a simple example of a small joint venture flip, just to illustrate. This is bread and butter, easy for you to understand, but purchase price 180, rehab 50, ARV 300,000. Let's say the profit at the end of the day is 40K. So if we are using this traditional 50-50 split, so everybody gets 20K, and if it takes 6 to 9 months, let's say it's annualized 12 to 15% for the investor. So this might be very lucrative, a very tempting type of a transaction for somebody who has been involved in real estate. If you get 12 to 15% annualized and you're a maybe tech investor or involved in crypto or something else where returns are higher, probably not your thing, so to say, but people who understand real estate, who appreciate that, especially when the numbers are better and higher, a very good way to make money for everybody. And then a couple of things here in the end about how I started. I have mentioned this already. I used bank loans for rentals way back when I started over 20 years ago. I had maybe 20 to 30% saved up and over time, and then I used that and bought the first one. This was with my brother when we did a bunch of rentals and a bunch of flips here in Europe. And so bank loan was always the thing for me in the beginning, and focusing again on the engine part. So you got to find the right opportunities, buy always at wholesale level, below market value in Class A locations, so that you can then get Class A tenants if that's your thing, if it's a long-term rental, and then that way you build equity by buying it low, rehabbing it smartly, and riding the market. And then I have used partnerships when I started my company in the US, or my 2 companies, and then I've used hard money to scale my operations. So hard money has always been the primary focus for me, has been to scale. So go from 1 to maybe 3 deals simultaneously. So when I was operating my company in the US, it was typical for me that I had 3 to 4 flips running simultaneously. That was really my maximum as far as what my crew was able to do, what I was able to handle with everything. So, and then when I moved back to Europe, so then I was able to take that to another level when I started doing new construction and larger renovation projects. And then again, for the larger projects, I used bank financing. So even though I'm not the biggest fan of traditional financing like banks, but sometimes it's mandatory, especially if you have a larger new construction project. It's not feasible to do that with hard money based on my experience, because of the rates, because of the buyers maybe appreciating that more, that there's a solid financing behind it, so-called more solid. So that's what I have done. And then we have a couple of more pages here to go through. So how to grow bank loans, if that's your thing. So make sure that your credit score is at the highest possible level. Then you have to have the W-2s and the corporate filings in place. That's in the beginning when you want to grow. And if you use bank financing and hard money, how to find these people. Nowadays it's easier because you have all the discussion forums, internet forums out there, and you can connect with people so much. It's more easy nowadays than what it was in the past, and just basically post your deal. And that's a good way to verify if whatever you have under contract is actually a solid deal. Because like I mentioned in the beginning, you will always find money. Money is just everywhere. Everything around us is about money. People just invest in doors and drywall and buildings and cars and tech and paint and light fixtures, and everything around you is about a business model that people were able to put together. So if your deal is good enough, it will find its capital source. There's plenty of people interested. That's not a problem. So do not worry about it. Make sure that your engine is cranking at the highest possible level. You find the opportunities and then choose one of these 4 or a combination of them smartly, so that you understand the pros and cons. And hopefully this video is going to help you with that. And partnerships and joint ventures. So use your relatives, your coworkers, your ex-boss, or somebody who has money, and don't be shy when it comes to reaching out. So squeaky wheel gets the oil, as the old saying goes. In summary, money is the fuel, not the engine. We have said that, or I have said that several times. I'm not going to repeat that anymore. If you have the right deal, money is not a problem. Understand your numbers, purchase ARV rehab. This is the thing. I mean, I have been in this game long enough to see so many people, so many different types of people who are interested in starting in real estate. Many people like the asset because it's tangible, and that's why I fell in love with it too. So I like the feeling when you have this empty canvas. So you go into a rundown property and you're like, okay, we can demo this whole thing and take it down to studs and do the layout again and think about colors and materials and how we can turn this ugly duckling into something really beautiful. And that's just the best part. And I think that's why it's very tempting to many, because it's concrete, it's tangible. So people like that. about real estate. But the number one mistake many people make is that they, like I said in the beginning, they think that money is a problem. No, money is not a problem. The problem is that you don't understand what a good deal looks like. So have you studied the market? Do you understand your purchase price? Is that at the right level? Did you underestimate your rehab? So number one problem, typically these are the problems. People pay too much, they underestimate the rehab budget, and they overestimate ARV. It's because you don't know, you're guessing. Do your homework, get comfortable with those ideas and those unknowns, so to say. When I started, and I'm saying I didn't do things perfectly in any way, but I understood that since I was a newcomer, a rookie in a new market, even though I had done real estate, I knew what I didn't know. And the thing that I didn't know is that I didn't know the local market. So the first 6 months, literally, I spent analyzing all the deals in San Diego County, in those zip codes, in those areas, in those parts of town that I wanted to operate in, because I knew that investors were typically operating in those parts of town. So I created this huge Excel spreadsheet, and I tracked every single transaction in those postal codes. So I had a very clear picture at the end of that 6-month period as far as what the purchase price was, how much these people, roughly based on my estimate, spent on the rehab, and I knew exactly what they got for the deal. So I knew I had facts about purchase and ARV. And then I knew roughly what the requirement was, return on investment was for these people in absolute terms and in percentage terms. And then I was able to look at the scope, look at pictures, and I even drove the properties to see them in real life, to understand that whether my assumption was roughly correct. And I was like, maybe 30 to 40K, 40 to 50K, 60 to 70K, depending on that. But I had a very good idea as far as what my numbers would need to be. And then I started making offers. If you don't do that, it's just guesswork. And then you don't force the appreciation, it's just speculating. And investing to me is something where you can actually influence the outcome. Otherwise, if you can't influence the outcome, you're speculating, and it's just riding the market. So there are 3 ways how you can build equity. Remember, keep that in mind. Riding the market is the most unpredictable part of that. Buying right, buying below market value, and rehabbing smartly are the 2 ways how you can influence the outcome. Riding the market is just a bonus. When you are in the Class A location with the Class A property with Class A tenants, if that's a long-term hold. Long story about number 2, understand your numbers, but that's really, really key, because with this stuff, you can get money. And don't get stuck, use leverage. That was all for today. I hope this was useful. I have only one ask. So if you like the content, please hit the subscribe button. I started doing this real estate content on this channel a few weeks ago, so I try to grow, I try to get better. All comments are always welcome. Again, I'll talk to you in the next video.